Well, with any luck, I might actually be able to manage to stick within my self-imposed guideline of 10 minutes. But even though I've only got a single point to make, I really wouldn't bet my house on it. Of late, there has been much hand-wringing and much flapping about the fact that the market is in drawdown. Here's a news flash for everybody out there who is surprised by this: markets go down. And if you don't believe me, here's a chart of the S&P 500 detailing drawdowns for the past 22 years. You can see the GFC, you can see the COVID pop, you can see the current drawdown, which at present value is about 17%. It nudged 20% briefly and then gave up the ghost and started to drift up. Now we're moving down again. The thing you should take from this is that drawdowns are a natural feature of markets. That's just the way they operate. If you're surprised and somewhat confused by that, then markets are probably not the place for you. But what has been concerning me of late, and it's not, concern's the wrong word, irritating the living daylights out of me is perhaps a more appropriate expression, is a chart that is a variation of this, that compares two time periods in the S&P 500 and overlays them. It compares a period leading up to and into the GFC and the fall from that point, and the current market from early August 2020. The implication is that, based upon this chart, that the market has much further to fall. That's one interpretation you could make. However, not trusting the way other people make charts, I thought I would make my own variation, because simple price overlays are problematic. And what I did was I looked at the value of $1 invested through the same time period. You'll notice along the bottom, the scale is the number of days. This is daily data, so this is daily return data I've used. And the reason for that will become apparent. You could look at this chart and say, well, the comparison is somewhat worrying, and that based upon this normalised data, that the market definitely has further to go, and that we should all be net sellers of everything, run and hide under the bed. But there is a problem with this sort of data, and it's a problem missed by every technical analyst who overlays one price series over another. And that is the nature of scaling. What I've done in this chart is simple. You'll notice the yellow highlight box. All I've done is made the lower limit for the GFC data 80 cents and not 90 cents. All of a sudden the chart starts to look different. In this next one, I rescaled both. And based upon rescaling of them both, you could look at the current market and say, well, it seems to be almost at the point of having run its course. There doesn't seem to be that potential for downside dip. There's definitely a differential there, but it's certainly not as bad as made out in our original chart. So I haven't changed the data. All I've done is change the way the data is presented. The moment you alter the scaling of charts that you've overlaid, you begin to generate a different output. The data looks different. And if you go off simple visual comparisons, you will be tripped up, because this chart here, which is a variation of the one doing the rounds on the internet, seems to indicate that the world is still about to end. Now, I have no idea whether it will or it won't, nor do you, which is probably a little bit of a shock to people. We have no precognitive ability regarding markets at all. That is just a simple fact of the matter. So I said the number of days would become important, and I just wanted to look at relative comparisons in terms of the number of days for the moves I've been looking at. These moves were 167 days. I used that as the basis for comparison. So I had the same data set for that point. Current market's down 16.6%. during the GFC, 167 days after the peak, the market was only down 12.6%. You can make of that what you will. I could offer the narrative that, well, the market's actually outperformed on the downside more severely than occurred in the GFC. Therefore, if I was naturally bullish by inclination, I could say, well, the worst is probably over because we've actually outpaced the GFC, which was a terrible event. That would, of course, ignore the history of the GFC, where most of the damage was done towards the end of the run, not at the beginning. But your story is whatever you want to make it. And so as to whether the market will keep pace with what occurred in the GFC, and we get a 53% drawdown, which would take us back to roughly where the COVID low was of about 22.52, is anyone's guess. And it is a guess. And that's the important word I want you to take from this. People who produce charts like that are guessing. And what they're attempting to do is to build a prop for their narrative. What happens is people already make up their mind about markets. And having done that, they then build a narrative to suit that. That's actually not what occurs in trading, because in trading there is no narrative, there is simply data, and you respond to the data. So whether our somewhat measly 17.02% drawdown turns into anything worse is anybody's guess. And again, it's a guess. So whether in days, weeks, months to come, we have a drawdown that resembles the tech wreck, the GFC, or the likes, is yet to be seen. And on this chart here, I've drawn a line from our recent maximum drawdown, about 20% straight across the chart. And you can see that drawdowns in excess of that are not unusual. But again, they're not predictable. Yes, you can make a case that the market is in downtrend. At present, there appears to be no, let's say, end in sight for the selling and the bearish sentiment that markets have. But again, that's a narrative. And it's a narrative I've just described and designed to fit my observation of price. More correctly, what I should say is, over the time frames I investigate and I trade, the market is trending down. The moment that stops, I will change my tactical view and adopt a different stance, which is the only thing that any of us can do. Because the moment you begin to make a prediction and you seek to build data to support that prediction, you've invested yourself in that prediction. And once we invest ourselves in a prediction, our ego will act to defend that prediction, which means that if and when we are wrong, which is inevitable because we are all wrong at some stage in our trading career, we will seek to defend that position largely by ignoring it. And this is why we have wonderful statements like, it's not a loss until you sell. Unfortunately, it is. And unfortunately, trading requires us to acknowledge that a great deal of the time we are wrong. But I come back to the wonderful point about trading, and that is that there is no nexus between being right and being profitable.